if we lower interest rates, it is possible we may never be able to raise them again. I know that seems strange, but you have to realize that the United States is now nearly at its 1946 peak of indebtedness relative to the size of the economy. It's important to remember 1946 was just after World War II, and the country was paying off all the debt that was run up during the war. I do believe, going forward, if the economy can maintain or continue to grow and the plans from the current administration generate more revenue, well, I think we'll be fine. However, if they don't work and the debt continues to rise, it would be hard to raise rates as it could scare current owners of Treasury debt as interest rate expense would climb dramatically, which would make it difficult to ever recover. This is one problem that Japan is already faced with. Their large amount of debt to GDP and the debt itself cannot keep going up forever as people eventually become scared and again begin selling their treasury bills, notes, and bonds. The average interest rate on U.S. debt is around 3.4%, which is not too excessive and could be paid off over time. Increasing interest rates in the future would be a problem because as debt matures, it could have to be refinanced at a much higher level than the current 3.4%. I do believe the best way out of this situation is to maintain the current debt, but increase the GDP, which is gross domestic product, which would then in the long term generate more revenue to not only service the debt, but also potentially be in a spot to begin paying down that debt. I'm Brent Wilsey with Wilsey Asset Management. If you like these videos, be sure to give a like or comment and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.